Welcome to today's Explainer. We're going to dive right in and logically deconstruct a highly complex system, the underlying mechanisms that govern U.S. tax residency for temporary educational and exchange visitors. Today, we're totally bypassing those surface-level assumptions to examine the strict cause and effect relationships and the non-obvious details that financially regulate a temporary academic presence. Think about the thousands of individuals crossing borders every single year, just assuming their visa dictates their entire legal reality. Well, let's get into the exact mechanics of why that absolutely isn't the case. So let's start by challenging a massive implicit assumption right off the bat. Does a temporary educational visa guarantee non-resident tax status? Now, surface-level logic might tell you that if your immigration status is temporary, your financial status just naturally follows suit. But actually, that assumption is fundamentally flawed. Let's systematically break down why a temporary visa absolutely does not automatically shield you from federal tax obligations. The consequences of getting this wrong, they can completely alter a person's financial reality for years to come. Here is exactly how we'll break this down today. First, the baseline separation. Second, the exempt mechanism. Third, strict time horizon thresholds. Fourth, the intent exception. And finally, the reporting absolute. All right, let's jump straight into section 1, the baseline separation. You see, there is a hard, very real line between physical borders and financial borders. Immigration law relies on classifications like undocumented or non-immigrant, but tax law, it uses completely separate classifications: resident, non-resident, or dual status. The crucial cause and effect relationship here is that holding a strictly temporary visa under immigration law can still trigger the mathematical test that classifies you as a full resident under tax law. Your physical permission to be in a country doesn't automatically dictate your financial classification. Imagine thinking you're just a visiting student, only to find out a totally separate government agency views you as a permanent financial entity. That baseline separation is literally the foundation of everything we're discussing today. Moving on to section 2, the exempt mechanism. Now, the legal definition of an exempt individual contains a massive, totally non-obvious detail. It's defined as a status where an individual's days of physical presence are temporarily excluded from standard residency calculations. Notice what's missing there. It does not mean they're exempt from paying taxes. Taxing authorities use a strict mathematical formula. Basically, they're literally counting the days you're physically present in the country. Being exempt simply grants you legal permission to ignore those days for a specific set period. It's like a mechanical pause button on a very specific legal clock. It is not some blanket shield against federal taxation. To be crystal clear, exemption pauses the residency clock. It does not erase tax liability on earned income. We really have to debunk the implicit assumption that holding a student or exchange visa grants you a free pass on financial obligations. Because if you earn money while your residency clock is paused, say through a university stipend or maybe a sanctioned on-campus job, you are still fundamentally liable for the taxes on that specific income under non-resident rules. This mechanism merely prevents you from being taxed on your global, worldwide income the way a permanent resident would be. That brings us to section 3, time horizon thresholds. According to expert analysis, the tax code mathematically categorizes temporary educational presence into 2 distinct pathways based on your primary purpose. Those holding student visas for academic studies are granted a threshold of up to 5 calendar years. However, those visiting primarily for teaching or research face a completely different, much tighter calculation. They are limited to just 3 of the preceding 6 calendar years. And this isn't arbitrary, right? The system deliberately grants a longer runway for students to complete a standard degree, while applying intense mathematical scrutiny to working professionals. Now, this 5 calendar year boundary for students, it is an absolute mathematical cliff. For exactly 5 calendar years, a student legally excludes their physical presence from the residency calculation. But the exact moment that clock ticks into the 6th calendar year, the mechanism shuts off. Instantly, Every single day of physical presence begins counting toward permanent tax residency. There's no grace period. There's no friendly warning letter in the mail. It is an automated legal pivot that fundamentally changes how your income is evaluated by the host country.
Contrast that flat 5-year student limit with the highly specific, rolling mathematical constraints placed on teachers and trainees. As we noted, they're exempt for 3 or fewer of the preceding 6 calendar years. But what's even more fascinating, and a really non-obvious detail here, is that this timeline tightens even further, dropping to just 2 years if their presence is entirely funded by a foreign employer. The mechanism is specifically designed to be mathematically unforgiving. It ensures that short-term professional exchanges remain truly short-term, or they face immediate financial reclassification.
Okay, let's get into Section 4, the intent exception.
So what happens if you need to bypass those default time thresholds? Well, there's an exact, highly scrutinized cause and effect sequence. Step 1, the standard time limit is exceeded, which pushes you toward resident classification. Step 2, you have to legally prove substantial, strict compliance with the original terms of your visa. But Step 3 is the truly heavy lift here. You must legally and procedurally demonstrate that you have absolutely zero intent to permanently reside in the host country and that you maintain a closer connection to your home country. This is exactly where the mathematics stop and the heavy legal burden of proof begins.
You can't just declare you plan to leave, you literally have to provide hard, evidentiary patterns of non-permanent intent. Authorities evaluate highly specific criteria. Are you maintaining bank accounts in your home country? Do you hold a valid driver's license there? Are you actively registered to vote? Does your primary location of business remain abroad? These tangible data points are the strict legal measure of intent. It's an objective test applied to a subjective state of mind, and it requires a documented, airtight paper trail of your ties to a foreign nation.
And here is the real kicker. If the mathematical timeline is exceeded, and the intent exception fails because you lack those evidentiary patterns, the consequence is severe. The mechanism triggers. The individual loses their non-resident status and is instantly classified as a resident for tax purposes. This means their entire worldwide income, not just what they earn locally, becomes legally subject to taxation by the host country. It's a massive financial pivot based entirely on statutory timelines and a lack of evidentiary intent. Everything you earn, everywhere in the world, is suddenly right under the microscope.
Which leads us to our final part, Section 5, the reporting absolutes.
Zero tax liability does not equate to zero reporting. This is a core mechanical absolute and honestly, a huge misconception. People think because they didn't earn a single dollar of taxable income, they are entirely shielded from federal filing requirements. The analytical reality of the system is the exact opposite. Assuming that no income means no paperwork is perhaps the most common and potentially the most damaging oversight in this entire framework. The whole system actually relies on mandatory informational returns. You don't get the exemption of days automatically just by holding the visa. The exemption is a legal claim, officially enacted only when this informational return is filed. And get this, it must be filed even if absolute zero income was generated. If no standard tax return is due because there was no income, this informational return is strictly required to be submitted entirely on its own. It is the mandatory trigger that makes the mathematical pause on your residency clock legally valid. Without it, the clock is technically still ticking.
So, we've deconstructed the underlying mechanisms today. The baseline separation of laws, the rigid mathematical thresholds, evidentiary intent, and mandatory reporting. It's a system of strict cause and effect that completely ignores assumptions and operates only on statutory data points. Which leaves us with a critical, provocative question for you to deeply analyze regarding your own educational presence. When exactly does your temporary stay mathematically trigger a permanent tax liability? Think about it. Thanks for joining us for this explainer.